as promised, to answer your mortgage questions, we're joined by Joe Bartlett, a mortgage broker who offers advice to would-be homeowners as the home buyer coach, no less. Well, Coach, I hope you're ready to put us through our mortgage paces. Good to see you there, Joe. Let's get our first question then. It comes from Lee, who asked this question. I know you'll have heard all of them an awful lot, but this is on many people's minds. Should I switch from a tracker mortgage to a fixed rate? So if you're on a tracker, I'm guessing your rate is going up because it's following the increase in interest rates. But a fixed rate, well, as we'll discuss a bit later on, they're quite hard to get and they're getting higher.
Indeed, yes. So a tracker mortgage is linked to the Bank of England base rate. So if this increases, then so would your payments. You may prefer the security of a fixed mortgage, knowing that your mortgage payments will be fixed for a set period of time. But that said, everyone's circumstances are different, and what's best for you might not be best for the next person. So it will depend on individual circumstances. So
just take us through, ballpark some of the rates. So what would a tracker rate be? What's the base rate's 2.25, if I remember correctly. Correct. So people are tracking at about 0.75 to 1.25 above that.
Yes, correct. Yeah, so, when you're looking at the tracker rates, they might look quite appealing, but the thing that you have to consider is what could happen to that rate if you do choose to go for that type of mortgage or remain on that type of mortgage.
And let's discuss it now through questions, because I'm going to talk more about fixed rates now. We've got this from Brian, and this is about timing. So many people wondering what precisely to do. So Brian's saying, my mortgage is due for renewal. And I've lost the rest of the question because my autocue's not turning over. My mortgage is due for renewal soon. Is it worth me trying to lock in a new deal now?
Okay, so I would say the sooner that you can talk to your mortgage advisor, the better. They can weigh up the different options and recommend the best option for you at that time. The issue that you have is if you leave it too long at the moment, it could potentially mean that you're paying more than you need to. So it's best sorting this out sooner rather than later.
OK, but how long can you lock it in for? I mean, it depends when your mortgage is due for renewal, and Brian doesn't make that clear. I mean, it could be some months away or it could be pretty shortly.
Absolutely. So with most lenders, with most of my clients, what I tend to do is give them a call around 6 months prior to when their mortgage fixed deal is due to end. And the reason for this is a new mortgage application, once that's been accepted, the mortgage offer is usually valid for a 6-month period. So you might be able to do something earlier than you think.
And so it's valid for 6 months. So people who locked in, 3, 4, 5 months ago must be feeling pretty pleased with themselves now.
Yeah, potentially so. Yeah, as long as they can complete in time, absolutely.
Well, we've got a follow-on question from Mike. This fits rather nicely then. I've completed my application to remortgage and I'm just waiting for an answer. Could the bank remove the offer now? Completed the application, presumably that means, I think Mike doesn't make clear though, that both sides then haven't signed it off. Offers can be withdrawn, can't they?
Well, yes, it will depend on what stage of the remortgage process they're in. So if they are in the middle of the application, lenders can potentially decline for, say, something like a down valuation on the property, or they're not happy with a certain aspect of the mortgage application. If the mortgage has actually offered, then the only way they can really revoke this is if there's been a material change, so a change in circumstances. This could be that the property value has dropped since the initial valuation had taken place, or perhaps personal changes like a job loss, increased debt, missed payments. That could be grounds for revoking the mortgage offer.
But crucially, grounds for revoking the offer are not that your other rates have gone up. The rate that you've offered this client is no longer available.
No. So if you had a mortgage offer agreed, then you will receive the rate that is on the offer. As I said, unless there have been material changes, which means that the offer needs to be revoked.
Well, just on that, that other point you make, one of the grounds for withdrawing offers, that house prices have fallen. Well, if you've had your valuation, who can tell? You need another valuation then, don't you?
Well, what a lot of lenders do is do an automated valuation. They've got, built into their systems daily updated valuations. So if they see a drastic change that means that the mortgage is, or the property is no longer suitable security for the mortgage, that could potentially be grounds for revoking the mortgage offer.
I see. Well, Tom's question coming up next follows on from that. And Tom, quite, I suppose straightforwardly asks this: is now the right time to be selling your house? And that's that's the 64,000. Well, much more than that dollar question, isn't it? It's your judgment on what's the direction of travel for house prices.
Yeah, it's a very good question, and one that I've been receiving a lot recently. So selling your house is always a very stressful experience, and now is certainly no different. There's a lot of uncertainty around the housing market, house values, which is understandable. Again, I mean, with most of these questions, it will depend on your personal circumstances. You may need to move due to a growing family. I always think that the best way to look at it is, the best time to move for you, not necessarily the market. And it's also important to remember that the property that you are buying will be in the same market as the one that you're selling in.
But you don't want to, I hear what you say, it's individual circumstances, of course, and houses are for living in, they're not for bartering, they're not financial instruments. But nevertheless, you don't want to get saddled with an overpriced house. You go into negative equity because house prices fall, and you're stuck with a large fixed rate.
Yeah, that's very true. Like I say, there's no perfect time to sell, and it will come down to whether you need to sell and what your circumstances are. So, if you job relocation, if you're coming to the end of your mortgage deal, the end of your mortgage term, you may be in a position where you need to sell. So, every customer is going to be completely different.
But what would your advice be to someone who said, right, OK, I hear you, need to sell, got to move, for jobs or family or whatever. But my view on house prices is they're going to fall. So I'm going to cash in the equity I've got in my existing property, and then I'm going to rent for a few months and see which way the wind blows.
Yeah, and that may be very well some of the opinions of current sellers and buyers. You'll need to weigh it up. There's no right or wrong answer. Look at the worst case scenarios of both options. So, let's just say that house prices stay low, and you're put in a position where you need to, rates stay high, and you're in a position where you're renting, and the rents increase because of the increased rates. So landlords are then passing that down onto their tenants. You could find yourself, a year or two later, spending £900, £1,000, £1,200 a month on rent when you could have gone for a longer term fixed product to secure the payments and know exactly what you can, know exactly what you're paying month by month.
That's an important consideration. Got a question from, I suspect, a first-time buyer. How is a first-time buyer expected to buy a property now with mortgage rates increasing? I'll add in and property prices still going up. What support is there? That question coming from Emma. So
we have just seen the stamp duty changes for first-time buyers, which really help with the upfront costs of moving. Also, there are still some really great schemes available for first-time buyers, such as shared ownership, the first home scheme, Help to Buy, although that is ending shortly. But yeah, there are still very, very, very good schemes available for first-time buyers.
There's also an ISA, isn't there, which can help with house purchases?
Absolutely, yes. So there was the Help to Buy ISA, which has now been replaced with the Lifetime ISA, which can really help boost the deposit.
And what about, just tell us the stamp duty cuts or the increases, they're different, they're higher rates for first-time buyers. Just talk us through what the numbers are.
Sure. So it was 300,000. That was the cap. This has been increased now to 425,000. So if you're buying below that, you won't pay stamp duty on the purchase. But
does that apply, the 425, then? Does that, say you buy somewhere more expensive, 500, 600,000 pounds, does the first 425 then not count when it comes to stamp duty?
So what would happen is the amount that you're buying up to £425,000 would be exempt from stamp duty. And then depending on the purchase price, you'll have brackets. So the first amount after 425,000 will be a percentage of tax payable. It's always best to speak to a tax advisor on this. As a mortgage broker, I can't give tax advice. So always best to speak to your tax advisor.
Well, all your other advice is really good, I can say. And not just on the issue of shared ownership, then the proportion which you don't own, you're paying rent on, and presumably that's going to go up.
Funnily enough, I actually own a shared ownership property, and I bought it fairly recently. And it was obviously one of the questions that I asked because I was concerned about rent going up. And for me, the reason for buying a shared ownership property was, I wanted to get back on the housing market. Sorry, the property ladder, and it meant that I could buy the property with a very low deposit. The last month, I received a letter from them saying that they're going to be putting the rent up, and it's gone up by £7 a month. So, I can manage that. The Help to Buy scheme and the housing associations really are there to help you. They're not there to sting you unnecessarily. Okay,
so they're the good guys. Question from Jeff, and some of it I think we covered, Joe, but just mention it again. Jeff asks, how can I save for a mortgage when rent is already so high? And this is the kind of catch-22 people get caught in. They just can't afford to save anything because they're renting and it costs so much.
Very true, yeah. So, forget what's happening now. It's never easy to save for a deposit, especially when you're paying a huge amount on rent. The good news is that some lenders can still consider a 5% deposit in some situations. Also, I'll bring you back to the various schemes such as shared ownership. So, as mentioned, it's a very good way to pay a smaller deposit than buying normally.
Got the mortgage and housing expert Joe Bartlett here with me, answering all your questions that you've been sending in to us all day with your concerns about mortgages, house prices and the rest. So let's continue with a question from James. James asking about the interest rate rises, and we know that there are more to come. The Bank of England signalled that very clearly today. James asks, is this likely to cause the housing market to crash and house prices to drop? Well, Joe, it's crystal ball time, isn't it? But what are the lessons from history when interest rates went up?
Well, I qualified as a mortgage broker in 2015, so I missed the 2008 recession. So up until fairly recently, we've been spoiled with great interest rates, and all of the conversations that I've had with customers previously have always been very positive. Look at how much money we can potentially save you. That has changed. With regards to the housing market, it's too soon to judge. All I can comment on at the moment is my personal day-to-day observations. And a lot of my customers are still actively trying to find properties. Some are struggling to have offers accepted, which shows that there's still a large demand in the market. It's very difficult to judge what will happen in the future.
And that's the point you're making there, Joe, isn't it? That interest rates and the price of borrowing money is just one factor in the value of housing. And one of the biggest determinants is, of course, as you touched on there, supply and demand. And the fact is we've known for many years now, we're not building enough properties, and the population keeps growing. We can all work out what's happening.
Absolutely. Yeah, I agree. It does help that they do have these schemes. There are builders out there that are offering, that are also, offering the schemes as well. So the supply and the demand thing it's been very difficult for buyers up until recently. The amount of customers that I've had that have been trying to buy a property for the last few months and have just had, no luck whatsoever, whether or not it's coming up against a cash buyer or, being outbid. It has been a crazy market.
And those of different generations from you, Joe. I mean, I'm a year or two older than you, but we regard 6% interest rates as, my goodness me, that sounds really cheap. I mean, I bought many moons ago my first property, and I was paying 15%.
Crazy, isn't it? Absolutely. Yeah, we have been absolutely spoiled with with interest rates. I remember doing interest rates at one point, below 2%, and it's just incredible. But they weren't going to last forever, and now appears to be the time when things are likely to change.
OK, here's our last question. And Joe, you've been brilliant so far. I know you're going to keep this up with Elaine's question, who wants to know this. Should I use my savings to pay off my mortgage or sit tight and wait to see what happens with interest rates next year? And that's alluding to the point, isn't it? Just because the prediction that interest rates may go to 6% doesn't mean to say they necessarily will. I mean, they could go higher, but they could well come in under that.
Absolutely. It's a very interesting question. So you may be able to counteract the potential rise in payments by reducing the mortgage amount, but it's important to check with your existing lender whether or not there are any early repayment charges, as you may be charged for paying off, a large lump sum off the mortgage. So that's the first call you need to make.
Yeah, and also, but if you are in a position, it sounds like Elaine is in a fortunate position, the idea of you could pay off some of your mortgage depending on what product you've got, presumably.
Absolutely. So many mortgage lenders, and it's important to check with your individual lender, but many do give you the ability to overpay by 10% of the outstanding mortgage balance each year. So it might be worth, utilising your savings to do that, rather than paying off a large lump sum and potentially incurring costs.
Well, Joe, we home buyer coach, we have had a proper workout. Thank you very, very much indeed. Some great advice to ponder and to take away with us. Joe Bartlett there. Thank you very much.